The rental application is complete. The apartment is perfect, close to work, affordable, safe. The landlord scrolls through the file, pauses, and turns the screen. A single number sits in the top right corner, 642. He doesn't comment on the applicant's degree. He doesn't ask about her references. He doesn't debate her character. He simply says, "We've decided to go with someone else." Across town, a hiring manager narrows a stack of resumes. One candidate is technically qualified. But before the offer goes out, the company runs a background check that includes a credit report. The file notes 2 late payments from 3 years ago. The application quietly moves to the rejection pile. In another office, an auto insurer recalculates a premium. The driver has never had an accident. But his credit-based insurance score flags higher statistical risk. The monthly payment rises by 30%. How did a 3-digit number originally designed to predict whether someone would repay a loan become a gatekeeper for housing, employment, insurance, even utilities? How did a tool built to measure financial reliability evolve into a silent infrastructure that governs opportunity itself? This is not a story about personal responsibility or individual missteps. It is the story of a financial architecture constructed over decades that transformed reputation into data, data into algorithms, and algorithms into power. It is the story of how credit scores came to control far more than just your loans. In the early 20th century, lending is personal. A banker knows your family. A merchant consults a handwritten ledger. Creditworthiness is a matter of local reputation, subjective, inconsistent, and often discriminatory. Decisions hinge on race, gender, accent, and social standing. There is no uniform system, only fragmented judgment. By the 1950s, America is changing. Consumer credit expands rapidly. Suburbanization accelerates. Installment loans finance refrigerators, cars, televisions. Lenders face a scaling problem. How do you evaluate millions of strangers efficiently? Enter Bill Fair and Earl Isaac, founders of what becomes the Fair, Isaac and Company, later known as FICO. Their proposition is radical. Replace intuition with mathematics. Replace personal bias with statistical probability. Feed historical repayment data into a model. Identify patterns, assign weights, output a score. The promise is seductive: objectivity. A neutral algorithm that measures risk without prejudice. The 1976 Equal Credit Opportunity Act reinforces this logic by prohibiting overt discrimination in lending. Quantitative scoring appears to be the antidote to arbitrary judgment. The core mechanics are deceptively simple. Imagine a whiteboard. Step 1. Collect data. Payment history, outstanding balances. Length of credit history, types of credit used, new inquiries. Each variable becomes an input. Step 2. Assign predictive weight. Late payments correlate strongly with default. High credit utilization, using most of your available credit, correlates with stress. Longer histories provide statistical confidence. Step 3. Compress complexity into a single output, a number typically between 300 and 850. The score does not measure morality. It measures probability. Specifically, the likelihood that a borrower will become seriously delinquent within a defined period. In 1989, FICO introduces the first widely adopted general-purpose credit score for lenders. By the 1990s, mortgage securitization is exploding. Loans are no longer held by local banks. They are bundled into mortgage-backed securities and sold to investors. Standardization becomes essential. Investors demand uniform metrics. Credit scores become the lingua franca of risk. A paradox emerges. The tool designed to reduce discrimination and increase access to credit also becomes a mechanism for mass categorization. It replaces subjective bias with systemic stratification. As the secondary mortgage market expands, government-sponsored enterprises like Fannie Mae and Freddie Mac integrate credit scores into underwriting guidelines. A threshold score determines eligibility. Below it, higher interest rates apply or access disappears altogether. The number migrates. Auto lenders adopt it. Credit card issuers rely on it. By the early 2000s, insurers began using credit-based insurance scores. The logic is actuarial. Individuals with lower credit scores statistically file more claims. The correlation holds, even if the causal link remains debated. Employers, particularly in finance and security-sensitive sectors, start reviewing credit reports during background checks. The argument is character assessment. Financial distress, they claim, may indicate risk of fraud. Landlords incorporate credit checks into rental screening. Utility companies require deposits based on scores. A metric built to answer one question, will you repay a loan? Now informs dozens of decisions about trustworthiness. Here lies the central paradox. The system that promises objectivity begins to shape behavior. When a measurement becomes a target, it stops being a neutral measurement. Consider the mechanics again. Payment history accounts for roughly 35% of a typical FICO score. Amounts owed, about 30%. Length of credit history, 15%. New credit and credit mix compose the rest. Notice what is absent. Income is not directly included. Wealth is not measured. Savings are irrelevant. The score evaluates behavior within the credit system, not overall financial health. This creates a structural bias toward those already integrated into formal credit markets. If you avoid credit cards entirely, you may lack sufficient data to generate a high score. If you rely on cash, your prudence is invisible. The system rewards participation. Now observe the feedback loop. A higher score grants access to cheaper credit. Cheaper credit reduces financial strain. Reduced strain lowers the probability of missed payments. The score remains high. Conversely, a lower score triggers higher interest rates. Higher rates increase monthly burdens. Increased burden raises the risk of delinquency. The score declines further. The algorithm does not intend to entrench inequality, but it amplifies existing conditions. The 2008 financial crisis exposes both the power and the limitation of credit scoring. In the run-up to the crisis, subprime mortgages proliferate. Many borrowers have low credit scores. Lenders price risk accordingly, often with adjustable rate mortgages that reset upward. When housing prices stop rising, refinancing becomes impossible. Defaults surge. Critics argue that over-reliance on credit scores masks deeper systemic risk. A borrower with a 620 score was deemed manageable risk if housing prices continued climbing. The model assumed stable macroeconomic conditions. That assumption fails. The catalyst is clear: falling home prices. The chain reaction is brutal. Mortgage-backed securities lose value. Financial institutions suffer massive losses. Credit markets freeze. Credit scores did not cause the crisis, but they were embedded in its machinery. They influenced who received loans, at what price, and how risk was distributed across the system. Post-crisis reforms tightened underwriting standards. Lenders demand higher minimum scores. The gate narrows. In the modern landscape, the architecture becomes more complex. FICO is no longer the only scoring model. VantageScore, created by the major credit bureaus, Equifax, Experian, and TransUnion, competes in the market. Fintech lenders experiment with alternative data, utility payments, rental history, even cash flow analysis from bank accounts. Yet the core principle remains: compress human behavior into predictive probability. The modern threat extends beyond traditional credit. In the gig economy, platform access often depends on background checks that include financial data. In insurance markets, credit-based scores remain widespread in many states. In rental markets facing housing shortages, landlords use automated screening tools that integrate credit metrics. Meanwhile, new financial innovations mirror the same logic. Exchange-traded funds bundle assets into standardized units. Private equity firms analyze portfolio companies through quantitative dashboards. In crypto markets, decentralized finance protocols assign algorithmic trust scores based on on-chain behavior. The blueprint is identical: measure, model, monetize. To understand the mechanism's plumbing, picture a pipeline. Data flows from creditors to bureaus. Each late payment, each new account, each inquiry becomes a data point. Bureaus aggregate and standardize this information. Scoring companies apply proprietary algorithms. They calibrate models using historical default data. If borrowers with specific patterns defaulted at higher rates in the past, the model assigns greater risk weight to those patterns. Lenders purchase scores and embed them into automated underwriting systems. An application enters. Within seconds, a decision emerges: approve, deny, or price at a specific interest rate. The human element recedes. Errors can propagate quickly. An incorrect delinquency reported to a bureau can lower a score. The lower score can trigger higher costs. The consumer may not discover the error until after damage occurs. Regulatory oversight exists. The Fair Credit Reporting Act provides dispute mechanisms. The Consumer Financial Protection Bureau monitors practices. Yet the system's complexity makes transparency difficult. The precise weighting formulas are proprietary. The score is both ubiquitous and opaque. What then should we watch? First, data expansion. When new types of data enter scoring models, rental payments, utility bills, even social signals, the boundary between financial behavior and personal life blurs further. Second, model governance. Algorithms trained on historical data may encode historical inequalities. If past lending patterns reflect structural disparities, predictive models may perpetuate them. Third, concentration risk. Three major bureaus dominate data aggregation. A breach or systemic error can affect millions simultaneously. Fourth, economic cyclicality. Credit scores perform differently in booms and recessions. During expansions, defaults decline and scores rise broadly. In downturns, shocks can cascade through tightly coupled financial systems. Finally, purpose drift. When a metric designed for loan repayment prediction becomes a proxy for trustworthiness across domains, its interpretive boundaries stretch. Return to the apartment applicant, the job candidate, the insured driver. Their scores do not measure ambition, skill, or morality. They measure historical interactions with credit products. Yet institutions treat the number as a generalized character reference. This is the quiet power of financial infrastructure. It operates beneath headlines. It shapes incentives. It defines thresholds. It rarely announces itself. Credit scoring was born from a legitimate problem: scaling trust in a growing economy. It replaced arbitrary judgment with statistical modeling. It expanded access to credit for millions who might otherwise have been excluded. But in solving one inefficiency, it created a new architecture, one where opportunity is filtered through probability. Understanding this system is not about gaming a score. It is about recognizing the design. When you hear about fintech startups promising AI-powered underwriting, ask, what data feeds the model? What assumptions anchor it? Who benefits from its thresholds? When insurers justify premium differences through actuarial correlation, ask, correlation with what and why? When policymakers debate housing affordability, remember that access to mortgages depends not only on income and supply, but on algorithmic gates. The three-digit number on a screen is not destiny. It is a statistical estimate shaped by behavior, policy, and economic context. But it is also embedded in contracts, platforms, and regulations. So return to that landlord, that hiring manager, that insurer recalculating premiums. They are not villains. They are participants in a system that translates uncertainty into numbers and numbers into decisions. The credit score does not merely predict risk. It distributes it. It prices it. It governs access to the modern economy. Understanding this isn't about predicting the next financial crisis. It is about seeing the scaffolding of everyday life, the invisible metrics that shape housing, employment, and mobility. A society that measures trust numerically will inevitably organize itself around those measurements. And once a number becomes the gateway to opportunity, it stops being just a number. It becomes infrastructure. In the end, credit scores control more than your loans because they have become a language of institutional trust. To navigate the modern financial landscape, you must not only know your score. You must understand the system that built it, the incentives that sustain it, and the limits of what it truly measures. Only then can you see where the architecture supports you and where its fault lines run.